Weighted moving average WMA. The weighted moving average WMA, like the EMA, places greater emphasis on recent prices by assigning them higher importance compared to older data. However, the WMA differs from the EMA in that it applies a simpler linear weighting method, making it less sensitive to recent price changes. The weighted moving average WMA combines a measurement of price movement as influenced by trading volume. This indicator places more importance on movements in price owing to spikes or steep drops in volume. In a volatile market, the WMA will be quicker to pick up changes in volume and move more closely to price than the SMA. What this means in practical terms is that the WMA even alerts a trader to a potential breakout sooner than the SMA. By adding the SMA and WMA on the same chart and comparing the two, you can get a more accurate picture of price action. For example, if the VWMA is trailing below the SMA in a downward trend, we can infer that there is significant volume pushing price lower. The opposite could be inferred in an upward trend, with the WMA floating above the SMA. The WMA will also alert you to a reversal a little sooner than ASMA, as you can see in the chart below, where the WMA is represented by the red line.